I'm going to say something most crypto YouTubers will never admit. Trading more does not mean making more money. In fact, for me, the more I traded, the faster I lost it. I blew a part of my account because I thought I was smarter than the market. I followed signals, I used leverage, I watched Twitter threads. I jumped into futures thinking one good trade would change everything. 2 weeks later, a chunk of my savings was gone. If you've ever stared at your phone watching your position bleed, hoping it would reverse only to see it liquidated, you know that feeling. And here's the twist. I didn't quit crypto. I stopped trading myself. The real problem with most beginners isn't that they're stupid. They fail because they try to become traders before they understand risk. You open futures, you increase leverage, you get one small win, that dopamine hits, and you feel invincible. Then you size up, and one bad move wipes out 10 small wins. You tell yourself, next time will be different, but it's not about strategy, it's about psychology. You're not just fighting the market, you're fighting your own emotions. And emotion almost always loses. So the real question isn't how to trade better. The real question is, what if you didn't have to trade at all? This leads us to copy trading. It sounds simple. You automatically copy the trades of experienced traders. When they open a position, you open the same position. When they close, you close. You don't need to analyze charts for hours. You don't need to predict every move. You plug into someone else's structured strategy, but let's be very clear. It's not magic. It's not guaranteed profit. It's delegated risk management, and that difference matters more than anything. The real advantage of what I call structured copy trading isn't just automation. It's transparency. You can see a trader's return history, their win rate, drawdown levels, trading frequency, and how long they've been active. Instead of guessing, you analyze. Instead of trusting hype, you trust data. And here is something most people miss. The best trader to copy is not the one with the highest return. It's the one whose risk profile matches your personality. If you panic easily, copying an aggressive trader will destroy you emotionally, even if they're profitable long-term. Alignment matters more than numbers, so how do you start the right way? First, create your account using the link in the description and enter the referral code ZORVTA9L during registration. That unlocks up to 40% in trading fee rebates on futures and spot, plus a welcome bonus package. Most people ignore fee rebates, but fees compound against you over time. Reducing them directly improves your net performance. After registering, go to the copy trading section. You'll see traders ranked by performance. Do not just sort by highest return and click copy. That's emotional thinking disguised as logic. Instead, check for consistency, maximum drawdown, trading behavior during volatility, and how long they've been active. A trader who spikes 200% in one short period but regularly drops 40 or 50% is gambling. A trader with steady, controlled growth is building longevity. And longevity is what keeps you in the game. Now let's talk about choosing a trader smartly. Look at their performance curve. Is it smooth or does it look like a roller coaster? Check their maximum drawdown. Ask yourself honestly, could you emotionally handle your balance dropping by that much without interfering? Because if you panic and stop copying at the worst possible moment, you lock in losses. Copy trading only works if you commit to rules before emotions kick in. Another powerful move is diversification. Instead of allocating everything to one trader, split your capital between 2 or 3 traders with different styles. One conservative, one moderate, maybe one slightly aggressive. This reduces your dependency on a single strategy and mirrors how professional portfolios are structured. And this brings me to the risk management most people ignore. Even when copying, you are still in control of your allocation. Set a maximum amount per trader. Define your personal stop-loss threshold before you even start. The goal is not to avoid losses. The goal is to survive them. Every single trader loses sometimes. The difference between long-term growth and account destruction is whether you stay in the game long enough for compounding to work in your favor. Instead of just trusting the marketing, I decided to test it myself. I allocated a controlled amount of capital I was comfortable risking. I split it between 2 traders, one conservative with low drawdown and a steady history, and one moderate with slightly higher returns but still controlled risk. Before starting, I defined my maximum acceptable loss. That rule was non-negotiable. During the first week, one trader had a small losing streak. I felt that familiar urge to switch, the urge to interfere. But this time, I didn't. I had already analyzed the long-term data. I committed to the plan. By the end of the test, I didn't double my money. I didn't get insane returns. What I gained was stability, controlled growth, and zero emotional stress. My account grew steadily without me staring at charts at midnight. That psychological shift was worth more than any lucky trade. So, what would I do differently if I were to start again today? I would begin even smaller and test for a longer period before increasing my allocation. I would track performance weekly, not daily. Daily checking creates emotional noise. Weekly review creates strategic clarity. I would also pay close attention to a trader's behavior during volatile markets. Anyone can look good in a trending environment. Real skill shows during corrections. Do they reduce risk or do they increase leverage emotionally? These patterns reveal their long-term survivability. And that brings us to the biggest misconception about all of this. Copy trading is not guaranteed passive income. Losses can and will happen. The difference is you're using structured delegation instead of emotional self-trading. When you combine disciplined trader selection, diversification, and controlled allocation, you shift the probabilities in your favor. If professional funds diversify strategies and managers, why would you put all your capital into one random trade idea you saw on social media? The edge is discipline. The platform provides the tools, but tools only work if you follow the rules. If you constantly chase the highest return, increase your allocation impulsively. Or switch traders after one bad trade, you are sabotaging your own strategy. The edge is not just clicking copy, the edge is sticking to your predefined risk structure. If you're tired of emotional trading and want a more structured approach, register through the link below and enter referral code ZORVTA9L when creating your account to unlock those fee rebates and welcome bonuses. Start small, test intelligently. Choose traders based on data, not hype. This is not financial advice and you can still lose money. But if you focus on risk management instead of chasing pumps, you give yourself a real second chance in this market. In crypto, the people who survive are not the ones who gamble the hardest. They're the ones who manage risk better than everyone else. Thanks for watching.